Basically, a contrarian approach means we're trying to think differently to other people, because we think markets are actually mainly driven by cycles of emotion. There are times when things are going well and markets get very excited, quite rightly too in some cases, but they tend to over-extrapolate things. And in contrast, there are times when markets get very depressed, again, often for very good reasons, but they can get too depressed. Now, what we look for as a contrarian investor is we think we'll find more opportunities where people are already depressed. We're not looking for things that will never recover, obviously. We want things to improve, but we're looking for opportunities in areas of the market that are out of fashion because we think the odds of a recovery are then in our favour. With unloved stocks, what we're really looking for is three things, really. We're looking for, ideally, them being out of fashion. If other people don't like them, that's great. We're also looking for them to be cheap and maybe with some sort of belt and braces angle to an investment case, and maybe a good dividend yield, maybe a relatively strong balance sheet. And then thirdly, obviously, we'd like them to have the potential to improve. There's no point buying a company that will never get better. And by that, we mean it could be a whole industry is out of fashion and it's maybe an industry that is cyclical in nature so it can recover, or it could be an individual stock situation that can improve. The market's got too depressed about its prospects. Well, areas of the market we think unloved are, firstly, for a while now we quite like gold. It's well off its highs of a number of years ago, which was reached in the European debt crisis. And the reason why we think it's interesting now is governments around the world basically seem to be saying, it doesn't matter how much money we spend, interest rates are cheap, we're going to borrow as much money as we can and spend it. There's a great deal of pressure to try and improve the economy. And frankly, politicians are realising if they don't spend the money, their successor from another party will do just that instead. So gold's quite interesting. One of our UK investments that was particularly successful recently was a company called RentaKill, which, as the name perhaps suggests, specialises in catching bugs. And it had a very checkered history. It would be a great growth story in the 1990s. And when we bought it, actually a lot of change had happened. It had retrenched back to its original core of pest control. Now, pest control is a good business because basically you can put your prices up every year. When we bought it though, it was out of favour, it was unloved, it did decent dividend yield, but the market was still judging it on its past mistakes. Technical term, it re-rated, and we sold it because we no longer saw the risk reward as in our favour, although we still think it's a very good business and will probably continue to do well, but it's no longer the sort of investment we want to own. Well, the thing about contrarian investments is they tend to have a higher than average dividend yield. That's not always the case, and we don't go out there looking for income, but it is an important thing that we look for because we know we're buying stocks that are out of favour, and we can't really be certain when they'll return to favour. We think the odds are in our favour, but what we want to try and do is have a sort of plan B, so that if things don't improve as quickly as we might think, we'd like a higher than average dividend yield because it provides some sort of return while we wait for our investment thesis to be proven. Well, obviously, we're human beings, so it's not easy to remain dispassionate. I mean, we're as prone as anyone to the market noise and all the commentary you'll read about everywhere. But one thing, having worked through the dot-com era, one thing that strikes us currently is that there's a very similar mood, particularly around technology shares. And again, it's very understandable why. We're all using search engines and we're all watching internet streamed TV. We've all got a smartphone. But the trouble is the market has over-extrapolated the good news and thinks it will last forever. And perhaps worse than that, there's a whole series of startup businesses with very dodgy business models, in our view, that don't really have a proper chance of ever becoming proper businesses that are valued extremely highly. And we find that concerning, and concerning about the whole mood in that area of the market. So We're keeping away from that area and we're focusing instead on areas where we see value. I think from witnessing a number of market cycles, what you learn is that while things are always different, in some ways the emotions mean they're always the same in many ways. And by that I mean that often an up cycle of a market or a trend or a stock even starts off with a very good concept. The original story is really very good. But what happens is time passes. By definition, the opportunity decreases as the share price goes up. But bizarrely, people get more excited about a story the more the share price or a market goes up. In contrast, when things aren't going well, people get really depressed. Share prices are falling. People just can't see any good news and don't want to be the first to step up to the plate because they feel they might be proven wrong. So, whether it's BRICS or whether it's Japan of 30 years ago or whether it's the dot-com era of 20 years ago or whether it's property of 10 years ago, the trick is always to say, well, yes, stories can be good. Yes, people can get very excited, but they won't last forever. But likewise, when things aren't going well, they can fall an awfully long way, but things do recover eventually. So I guess the trick is to try and find a middle road between all that, right through the market cycle.